Welcome everybody to the New York City Virtual Real Estate Expo. I am your host for this session, Michael Romer. I'm the co-managing partner of Romer Debbas. I'm also the co-founder of New York Real Estate Center, an online real estate education platform. And I'm happy to be joined today by my friend and colleague, first senior vice president at Valley Bank, Chris Coiley. Chris, how are you?
Good, Mike. Nice to see you. Hope everything is well with you.
Everything is great. And I'm excited that you're joining me today and grateful that the NYC Network Group had set up this expo and invited us to come speak. So I think they're doing a great job. But today, our focus is on commercial lending. The topic today, folks, is follow the money. Where are commercial lenders looking to lend in today's market? Needless to say, the last year and a half have been challenging, not only for real estate attorneys like myself, but for commercial bankers like Chris. But throughout all the craziness of the pandemic, an interesting thing really happened. Business continued. Real estate deals kept transpiring, banks kept lending, and a lot of activity has taken place in the last year. Chris, I can only speak for myself, but from our standpoint, we're experiencing one of the busiest real estate years I've ever seen. How about you?
So yeah, you would have thought with the pandemic it would have slowed up, but I guess it was last year we saw probably our most active year in lending, which was pretty interesting. We needed to get over a few of the hurdles of working remote. How we were going to do approvals, inspections, all sorts of things that we just kind of took for granted. We got over that, and this year we're at least 25% up than we were from what was already a record year last year. So it's been a very interesting time.
Yeah, it's amazing. And we're seeing the same thing on our end. Just the uptick in activity across the board has been really promising. Now, coming off the pandemic, who would have thought? Coming off the height of the pandemic, when we thought, okay, the world is ending, where's this market going? And then all of a sudden this switch flipped and it resulted in a lot of activity throughout the New York City market, as well as other areas. But, my office is based in Midtown Manhattan, but Chris, Valley Bank covers New York, tri-state. Where else?
So we've got offices in Florida, Alabama. We've recently opened up an office in Pennsylvania in the King of Prussia market. We're seeing our expansion, real and in areas that are very strong. The Northeast is obviously a very strong market. The growth that we've seen in the Florida markets are unbelievable at this point. This is kind of a new world right now we're dealing with in real estate. So I think the remote aspect of everybody, it's no longer, if you're working in New York, you have to be there. We have people who are in Texas who remote work with the bank these days. So it's a very different time, and again, I think it's a pretty exciting time to be in lending.
Yeah, I'm happy to hear that. Look, as a commercial lending attorney myself, I'm certainly happy to hear that. But just over my career, and this is now 20 years representing banks, I've always felt that if banks are lending, where banks are lending is a true indicator of the market, the real estate market as a whole. So in this conversation, we're talking about the commercial real estate market. Now, one of the hardest things that I've seen throughout the pandemic, especially in the New York City area, is valuation. When we're looking at how to value these properties, will these properties appraise? Now, obviously, during the height of the pandemic, in-person appraisals really weren't possible. But how did Valley Bank handle that throughout the pandemic to really try and get a sense of what properties were worth?
Mike, that's a really, really interesting question, because different asset classes did better than others. So we saw, distribution centers, say on the industrial warehouse side, we saw that market go crazy. Whereas we saw the office market, really take a dive. So, how we really looked at things, we learned what pandemic-proof tenants were. We really stressed our underwriting. So if we were looking at vacancy rates, traditional vacancy rates in the tri-state area of 2 to 5%, we we jumped them up to 5 to 10%. So we were probably a little more conservative in the underwriting approach. But when you bank the right people, right, the right sponsors, I think that was, I think, our strongest attribute. You can follow the money, you can follow property types, but if you're really looking at a strong sponsor, somebody who's backed their projects, um, that was, I think, what's led to our success.
So what you're saying is the key really was about the people behind the loans, the borrower.
Absolutely,
And
absolutely. If you're going to do business with, we've all seen it over our careers where you have somebody who's got we used to joke, a dollar and a dream. They've got a few bucks and I'm going to all of a sudden start investing in something, but they don't have that experience, how to work properties in down markets. So we do talk about that in our committees, and have people been through the wars? Have they been through the recessions, the downturns in the market? And the people who've been through it, survived, are the people who you want to continue to bank.
so, I mean, would you say over the last 18 months that you predominantly serviced prior clients, existing clients, or did you see an uptick in activity from new clients, new borrowers, new
S-
clients of the bank?
I would say a fair amount was existing clientele, um, but we took it as opportunity as well. There were banks they stopped lending. There were a lot of banks that just pulled the reins in and said, we're not going to lend anymore. We're going to see how this all pans out. We didn't take that approach. We really looked at it as, look, we're going to get out of this. We're going to get through it. It's just a matter of, how long it takes. Um, some of the regulations that came down, the bank, our bank regulators gave us kind of an edict of how to really work with clients when it comes to the deferment process. So bankers shifted gears. They had to figure out how to work through problems, as opposed to the old edict of, foreclose, on the landlord side, evict. You tried to work with clients as best as you could. And we still, for a few loans, we're still doing that on. So, but I think for the most part, we're like, what we're seeing is we're mostly through the major problems.
Now, and that's obviously great to hear. Now, from the foreclosure standpoint, from the forbearance standpoint, did you see many loans go down that path? I know as a relationship bank, you really try and work with your borrowers and work with your clients to get them through tough times. But in this situation, did the bank as a whole see a large amount of foreclosures, forbearances, or were you looking at situations where the bank just worked with most of its borrowers to get through?
You had to work with them, and we were, and again, not just Valley, but pretty much the industry. Um, if you took that hard line approach, it just didn't work. There were people saying, "Fine, if you don't want to work with us, here are the keys." And that's not really where we all were. We were all in this together. The PPP loans that a lot of the banks, everybody partook in it. Everybody was trying to work through the night. We had situations where, we really felt, we were the money line for a lot of businesses. And, the government stepped up, did what it needed to do to kind of keep things going. And, the banks, definitely stood up and were that funnel for that.
It was interesting. And we deal with a lot of commercial banks and commercial loan officers, and there were so many that I talked to throughout the pandemic that overnight had to become experts in PPP loans. We as a law firm had, we had the blessing of being able to obtain a PPP loan, but dealing with the banks, many banks really had to just change their course overnight
Well,
and become
Mike,
a
we
PPP
we
lender.
we actually created our own package, our own software. So it got to a point where, like you said, SBA. I've been a real estate lender for 30 years. So when they said, this is what you're going to do, we all figured it out. We rolled up our sleeves. We had shifts through the night. There were nights we were 2, 3 o'clock in the morning because The SBA funnel, we had to get everything through their portal. What we found out was, everybody was doing it during the daylight hours. So we kind of shifted and said, let's send everything, through 1 o'clock to 5 or 6 o'clock in the morning. So we had people that were working shifts like that just to get things through, into their systems. So, it was, for us, it was a very exciting time. We never want to go through it again, but for a bank that was primarily, the Northeast and the South, there was a lot of people down in Florida who I had never met before. This was, everybody rolled up their sleeves. We were on Zoom calls. We were on, calls to go through systems processes, even for approvals for the PPP loans. We were kind of one, at that point, we became one bank, and that was really neat to be part of.
Yeah, look, the one of the positives, not that there are many, with respect to the pandemic, but there were some unifying factors. It brought people together. It brought divisions within banks or within law firms together. Maybe not so in person, but the ability to have these conversations on Zoom and other formats just to keep connected throughout this process has really helped all of us continue to do business. But circling back to where the money's going, because I think that's really where most people want to hear. They want to hear your insight in terms of, well, what is Valley looking at today? Maybe what are they looking at that maybe other lenders might not be looking at? Now, I know from personal experience that Valley is very active in the multifamily space, in the industrial space, underlying co-op mortgages. I mean, that is the bread and butter from my standpoint. Would you agree?
Yeah, we look, we looked at, you kind of had to go back to the basics in real estate. Number one, people need a place to live. And when it comes to it, you got to pay your rent for your apartment, or, buy your home, or, these are things that we looked at and said, we got to go back to the basics of real estate. Location was, is always important, sponsor driven, but when it came to the asset classes, we really did sit back and say, okay, what's surviving, and that, as I said before, that pandemic proof type asset was something that we were really focused on. But in the same breath, there was something that came out, the emergence of the industrial warehouse market. All of a sudden, the distribution lines, you're not going to your retail store as often or as much. And, Amazon was crazy. I mean, I used to laugh every time I come to the house, there were boxes of the Amazon boxes. And I'm sure that we all had that same issue. But it really comes down to looking at the asset classes. Office definitely softened up, so we were doing a lot less of the office. Residential, people want to, the multifamily market, people have to live somewhere. The industrial warehouse space, that got so hot that even in the investor side, it was tough to buy something, because you were buying at a 3 cap or a 3.25 cap, which for industrial property has never been the case. Residential development in the suburbs, huge. Dealing with some of the larger residential builders, it was amazing how quickly their projects were selling. So those are things that we saw. On the retail side, because retail softened up a little bit, what we found was, if you were anchored by a ShopRite, or these those were the centers that did well. That those necessary centers where people live and breathe in the towns, in the suburbs, did very well. We're really hopeful that that the office market in New York comes back. We've seen some pretty good signs. All the reports that we're reading now definitely is going in the right direction. But the lending parameters, say 5 years ago, the lending parameters today have changed. So maybe there's a little less leverage, or you're really focused on where the leasing rates are on the office side. So these are all things that we look at on a deal by deal basis.
Both of our companies have space in Manhattan, and we're looking at what the leasing rate is, what the market's like right now, because right now, by most indicators, Manhattan offices, you only have about 28 to 30% of these spaces or employees coming back. So that's only, it's not even a third of the work staff back in the city. Most folks that are projecting see maybe that number going up to as high as 50% come early in the year. We'll see how that plays out. But it does change the game a bit too. When you're looking at office buildings, big or small, how do you value them? How do you actually come up with square footage? Now I'm dealing with a situation now where we're talking to our landlord about potentially taking more space, hard to believe, and trying to be economical at the same time. But how do you do that when you have employees that might come in 2 days a week, 3 days a week? You know, there's this flexibility that is now part of our everyday life, the ability to work from home that a couple of years ago, you know, I used to make the joke that working from home was working from home. And now it's actually real work from home. And I have attorneys that work in our office that are more efficient actually working from home. They're billing more hours because they're taking out the commute time. And the interesting thing is, I think this is here to stay. I think we're looking at some type of hybrid where folks go to the office, they've got some flexibility to work from home. But it circles back to that question when you're looking at the building from a bank standpoint. Does that impact your willingness to lend, whether only 30 to 50% of employees are coming back?
I think when it comes to the office side, it definitely will have an impact. I think the concern is right now as banks are looking at, you had all these leases that were still in play. You know, to your point, you know, I don't know when your lease comes up with your landlord, but there's obviously going to be a negotiation at the end of the lease if you're close to it. Now, is it less than what you were paying? Most likely. So you're kind of getting into the situation where does it make sense to, you know, to take 100% of the space, 80% of the space, do shared office, do, you know, we have a lot of communal offices that, you know, where we project, you know, in a similar fashion, it's going to be, it's going to be some kind of reduction in the everyday work. So I think that's going to be the question that comes out in the next year or two.
I think it's going to take some time for this to play out in terms of especially in New York City, what office like that. I was talking to my wife about this morning. She works at an office in the suburbs in Westchester County, and in her office building, they're basically back to 100%. And you know, I counter with, well, in Manhattan, we're dealing with only 30%. And there is this big difference. There's a deviation out there between in the city, in the hub, and in the suburbs. And throughout the pandemic, we were seeing a ton of activity in the suburbs, new leases, new businesses, tons of commercial loan activity, industrial warehouse loans. I mean, I've never seen so many industrial warehouse transactions. And we were talking recently about instances where you had these warehouses that were going substantially up in value over a short period of time just because of the demand.
So yeah, it was interesting when we talked about when you talk about the office space, the suburb office space. You know, we're 3-4 days in here. You know, some of us are or 5 days here. So, you know, when you're really looking at things, the suburbs, I think there was just more comfort with not having to deal with mass transit, not having to deal with the density of the New York City market. You know, there's but you know, to that end, Mike, just, and you know, you're a New Yorker by, you know, there's nothing like, you know, when you walk into the streets of Manhattan, the vibrant, the people, you know, it's energy. That's going to get back. It has
And
to.
it's starting to.
Yeah.
I've been coming into the office a couple of days a week since June 2020, you know, when things were just very, very quiet in the city, and I've slowly seen it come back to life. So there's a lot of positivity. Yes, I, for one, feel that energy. I enjoy it. I feed off it. I'm looking forward to live events. Recently sent out a poll to our database about whether people are comfortable going back to live events. And surprisingly, it was 65% of people that responded are getting ready to start attending these things.
Yeah.
I know you feel the same way, but I think time will tell. It's just going to take a little more time for people to feel comfortable. But things are slowly turning back to normal. But with respect to remote work, that's here to stay. That's always going to be a component of what we're looking at.
Oh, totally agree. I mean, and you talk about efficiency. It's going to be viewed a little differently. I think that there is um, a give and take. And is that monetary? I don't know. That's going to, I think, something that's going to play out over the coming years. Do we have people that say, look, I'm only interested to work 3 days in the office and 2 days home? These are things that, if they're working, if they're efficient, great, have at it. But we also know that that's not always the case. And that's not always the most efficient. People may think they're good or they may think they're efficient at home, but they're really not.
The other thing
And
is
these,
retaining people. It's really hard
right.
to retain people when you don't see them. And we see that, like, as managing a law firm in New York, it's hard to keep people when you're not seeing them on a regular basis. You lose that camaraderie. We're trying to offset that by a lot of social events to try and keep people engaged, to get people to come in. So we talked a bunch about the multifamily side. The bank has always had an interest in those type of properties and projects. The industrial warehouse market, which has been very active throughout this. Now, we were seeing a lot working with your bank and others in the underlying co-op space. Why do you think that is?
The interest rate market is still phenomenal. And although we've seen an uptick in treasuries, you're still talking, you're seeing interest rates sub three for your underlying co-op loans for 10 years. That's pretty phenomenal. People still, they take pride in the buildings that they're in. They want to make sure they're upkept. So, I think that market is always going to be there. But I think that as far as the underlying co-op market, if you haven't refinanced, or if you haven't financed within the last, 4 or 5 years, and you're paying a rate that, you should. I mean, it's literally been driving the market, and there's a few players out there in that, and they understand that marketplace and the risk profile, because it's not really a real estate risk profile. It's more of an interest rate risk profile. So, if you as far as a bank goes, if your balance sheet is balanced, you can play in that market. So
Yeah, it's a very niche market, and a lot of people outside of New York don't really understand the co-op game and how it works, what a co-op building even is. Because people that are buying a co-op unit, which is an apartment in a building, you're actually buying shares of stock in a corporation as opposed to the real estate itself. And these corporations, as they're formed, they typically operate as not-for-profit corporations,
right.
where their sole mission is to really cover their expenses. So at the end of the day, it's as if the individual owns that unit, but they really don't. They own shares in a corporation, and then they get a proprietary lease to the unit. Now, the question then oftentimes is, whether or not the corporation, owns the land, and that sometimes is a question. Sometimes you have a land lease under the property. So when it comes to a typical building that's sitting on land that they own, if they haven't refinanced in the last 5 years, now's the time, right?
Oh, absolutely. Look, it's you at the end of the day, we're all looking at what the cost of money is, and it drives your residential refinancings. It drives your commercial refinancings. So, what investors are paying on rate right now, and although co-ops are not really not an investment side, but it's so low that you can't not take advantage of it. So where we see this going, and I've been saying this for probably the last 5 or 6 years, rates have to go higher. Well, sooner or later they do have to go higher, because this is the lowest that I've ever seen it. With everything going on in the marketplace right now, and we all fill up our cars, and we all know what the price of living is. To take advantage of long-term fixed rates, you should. So if you're even if you're your home, you should be looking at at that, because you're fixing a cost for the next, 15 to 30 years. You can't beat that. And that's really the game these days, is trying to, fix what your expenses are going to be.
Especially in today's world of inflation, increased prices, the cost of everything is going up, whether it's goods to real estate or lumber and all the materials that go into real estate. The price of everything is going up. So if you can lock in capital at low interest rates, I mean, at some point the rates are going up. Depending on the market, whether it's commercial or residential, there's different feelings in terms of when the spike's really going to happen. But on the residential side, I mean, you're looking, I took out a 30-year mortgage recently and it was under 3%. I mean,
Right.
for somebody who's been in the business 20 years, that's effectively free money. And, I don't even
Not,
want to
qu-
say it, but
not quite free.
not quite free, but it's a lot lower than my first
Right.
mortgage. But there's a short window on that. I think over the course of the next year, you're going to start seeing some increases on both the residential, and the commercial side
And the
because
Fed has given its bias to that. They've said, look, they have to almost raise interest rates. I do kid, one of the funniest things I said was, oh yeah, somebody, I took my wife somewhere expensive. We went to the gas station. These are all things that, we could joke and kid about, but they're real. So even to the point we were talking about remote working, you know, you kind of take a real macro look at it and go, well, maybe that's going to drive people to work from home more, because it's a little more expensive to get in, getting over the bridges and the tunnels. It's not cheap. So, these are all things that in a business model, you kind of have to look at it. And as an employer, are you going to be flexible, or are you going to, and again, to going back, we have to be flexible. We have to be more flexible today as investors, as bankers, as lawyers, and really you got to figure out how we're going to get through this and what the new normal is going to be.
yeah, and I think that's going to play itself out over the next year or so. This year, despite all the challenges that we've all faced on the business side, has been great. I think in the real estate sectors, attorneys and banks alike have been very active. A lot of record years, a lot of record numbers, and we're seeing a lot of transactions. Now, I was talking to one of your colleagues recently, and I was talking about all of the construction that's happening, especially in the suburbs. A lot of residential developments, individual new homes, and I mentioned one to a colleague of yours, and that was in Bergen County. I said, I was using that as an example. And he looked at me and he said, Mike, I did the loan on that, and actually I didn't realize that. But the funny thing is, it just shows that there still is an appetite. And you and I have talked about this over the years, but there still is an appetite for construction loans.
And that project is, the sales activity at these projects, in the suburbs, especially the suburbs, has been phenomenal. Something that, when all of a sudden everybody goes, I got to get out of the city, and not just New York City, but we saw Jersey City, we saw Brooklyn, we saw, the Hobokens. Everybody's like, there's too much density. It made people nervous. So I'm going to go buy a house out in the suburbs. The home builders, very well. They did great. The only issue that we ever saw was really more on the approval side, but even the entitlement process seemed to get they seemed to get it quickly. The Zoom meetings, all those things, that in the past were, you could take 2 or 3 meetings to get through. It became a little more efficient. So that activity was extremely brisk, and continues to be extremely brisk. So, we're there's only so much land, and especially the national builders, they pump through these projects. Even with the lumber costs going up and steel and everything going up, they still made it. They still made sense. So
Now
that's
we're
just
getting towards the end here, Chris. So it's a little bit of crystal ball time. So where do you see the commercial lending market going into 2022? More of the same, or do you see anything changing?
I definitely see it being quite similar, but I still think that you're going to see what the ramifications of the office market is. So I think that that may fluctuate a little bit, but I think residential is going to be very strong. You know, the multifamily sector is strong. And I think that as we get through, you know, the pandemic, people going out, people wanting to go back to restaurants. You know, I mean, I went to the Ranger game the other night. It was a blast, and you kind of look around and you're like, where was, you know, there's nothing wrong. You get your, you know, you have to go in and you give your proof of vaccination, but you know, it was great to go to a live event. So these are all things that I think human beings, we want to get back to normal, and it's going to be up to us to do that.
And I think we're getting there. And I see Anthony has joined us. And I just want to personally thank Anthony Kazazis, the New York City Real Estate Expo, the NYC Network Group, as well as my friend Chris Coiley from Valley Bank for this presentation today. And Anthony, I'll leave it to you.
Thanks, Anthony.
Yeah, thank you, Michael. Thank you, Chris. It's always an honor. You know, I love having Michael and his partner Pierre Debbas always at our trade shows, helping out, whether it's moderating or interviewing people. They're really great guys, and I want to thank you again, Michael, and thank you for that dinner in Atlantic City as well.
We have to do that again. Speaking about things going back to normal,
I'm on board for that.
Yeah, I know you are, Chris.
Anyway, just needs to come a little quicker.
A little quicker.
Exactly. Michael, Chris, thank you. And this concludes our webinar.
Thank you
Bye-bye,
very
everybody.
much.